Good morning, everyone, and welcome to today's webinar, Manage Your Business FX Risk and Get Cash Flow Confident with Michael Judge. Today, you will listen using your computer speaker system by default. You'll have the opportunity to submit questions to Michael by typing them into the questions pane on the control panel. You may send in your questions at any time. We will collect these and address them during the Q&A session at the end. Michael joined OFX in 2009 and oversees consumer and corporate segments from the ANZ market. Born and raised on Sydney's North Beaches, Michael has a Bachelor of Commerce and Diploma in Financial Services from Macquarie University. He has over 10 years of experience in global financial markets and provides regular insights and commentary to the business community and media, including Business Insider, AFR, Macquarie Media, BBC, Sky News and other outlets. I will now hand this over to Michael.
Thank you, Ida, and welcome to everyone that's joining us this morning. Obviously, OFX is delighted to be hosting this webinar. Obviously, the key theme of what we'll be covering today does speak directly to not only what we are observing in the markets of today, but I suppose more broadly and often more importantly, covering some key topics around currency risk management and how important it can be to partner with an FX specialist when looking to reduce some volatility and manage risk within your business. Just firstly, obviously appreciate a lot of people today are in fact new to OFX. So I think it's really important, obviously, just to give people a little bit of an orientation around us as an organisation. As Ida mentioned, not only am I'm born and bred on Sydney's Northern Beaches, but so is OFX. And we were essentially founded back in 1998 on an idealism, I suppose, that there had to be a fairer and more valuable way of exchanging funds globally. So I suppose our role with a lot of conversations that we have with our customers today still come back to those principal or foundational enablers. That is, it needs to be, obviously our role, is to remove the complexity, some of the anxiety, as well as obviously some of the costs, which is too often associated with sending funds globally. So as I mentioned there, obviously, we will be talking a lot about currency risk management, and we will obviously be talking a little bit about, obviously, the markets of today. So just firstly, in terms of what we are observing in the marketplace of today, I think firstly, it is really key to call out that 2020 has been quite a profound year for FX markets and global financial markets more broadly. For a lot of importers and exporters who are navigating the markets of today, many of you would have been shocked to observe currency fluctuations of circa 35% over a short period of only 6 months. Obviously, for businesses who are operating through those levels of volatility and often operating through those levels of volatility for the first time, that can obviously create a whole heap of risk in underlying business models and particularly challenge a lot of businesses who are trying to turn their businesses into profitable organisations. But what we will talk about around currency risk management really is the importance of being situationally aware. So again, one of the reasons OFX will typically spend a fair bit of time invested with their customers speaking about the markets of today is that the markets of today will and should often align to obviously not only who you're partnering with to manage those risks, but it should often overlay to some of the products that are typically considered best use in this type of climate. So just firstly, as I said, a quick review in terms of the year that it has been for FX markets. Mentioned previously, we've seen a 35% variance in the Aussie-US exchange rate alone. Now that level of volatility, frankly, is unmatched. And we actually have to go all the way back to the GFC environments of 2008, 2009, versus when we saw that level of jolt or that level of impact across currency markets. I think it's a really fair thing to say that too often in financial markets and too often in currency markets as well, the term volatility and the term uncertainty is too often overplayed. And there can often be a whole heap of risk and a whole heap of fear, which is too often elevated when we're referencing the Australian dollar. But I do think, particularly in this environment, those two words, be it volatility and uncertainty, are absolutely being applied, I suppose, accurately in the context of the markets of today. I mentioned that we hadn't seen this level of volatility since 2009. And I also mentioned that terms of volatility often being too used, which is to say, in the main, over the over the past 5 years in particular, what we have seen for the Australian dollar is a well-controlled and very conservative decline in the AUD. Now, often that stability that we've observed pre-March of 2020 certainly has been thrown out the window since. We really have seen, obviously, a big shift in the dynamics of markets, and as a result, a big shift in how currencies are behaving today. So I think, firstly, if we ground ourselves in the markets of today, a couple of things, I think would be really important for the audience to kind of pull apart and to really understand where they can a little bit more deeply. The first of which is to understand, obviously, the response that we're seeing off the back of the COVID-19 pandemic. Cast our eye back to March and April of this year. Of course, the first response from all of global banks globally, as well as a lot of governments globally, was to provide record levels of stimulus and equally record levels of support for global markets. So as a result, we all know we saw interest rates go to new record lows already off pretty low bases. And equally, we saw a fiscal response unlike anything we have seen, frankly, since the Great Depression of 1930. As a result, we saw a mass level of stimulus injected not just locally, but at a global scale. And essentially what that has delivered is record levels of liquidity and, again, record levels of support for the market. And as a result, we've seen currencies like the Australian dollar retrace their steps up to the highs that we saw or back up to the levels that we were observing pre-COVID-19. So I think, firstly, the context is really important. We've gone on this really abrupt journey over the last 6 months. Markets have regathered their values as to where we were pre-March. But a lot of that, again, has been achieved off the injection of cash and the injection of liquidity from both central banks and governments. And these levels at the moment haven't necessarily been established on any deep foundational strength in underlying economic performance. So I suppose at the moment, as I said, we probably are at a real inflection point for markets, where the recovery has been led by stimulus, not necessarily led by economic fundamentals. I think the second part, outside of the COVID recovery, is, I suppose, an acknowledgement of relativity. And the Australian dollar in the main has done a fantastic job of recovering versus a lot of its global counterparts. And a lot of that recovery, and a lot of the narrative tied to the Australian dollar, again, comes back down to a COVID-19 related narrative, which is to say, we are already seeing a lot of second, third, and in some cases, fourth waves of infection across both North America and Europe in particular. And that, as I said, is a real, I suppose, headwind for a lot of the G10 currencies globally. A headwind, I suppose, the Australian dollar isn't necessarily facing, I should say, by comparison. So if we look at, obviously, the stimulus measures of global central banks, so as we wrap that up in the context of a global COVID-19 pandemic, I think the final piece, which is obviously very topical today, it does speak to, obviously, the geopolitical climate that we're operating through. So first and foremost, obviously, next week, we do have the US election. And we are already seeing a whole great deal of, I suppose, preparedness happening from businesses who are needing to navigate these waters. Volatility levels and trading bands in particular have started to tighten in preparation to that event. We have seen risk premiums also become a little bit more expensive in preparation for that event. So not only have we already recently, I suppose, navigated some big jolts and to some big shocks, I think those recent lessons, and in some cases, those really hard lessons, have actually, I suppose, heightened the level of preparedness that we are seeing in the lead up to next week's US election. Of course, if we cast our eye back to 2016, it always serves as a really good benchmark in terms of how markets could well, obviously respond to an election result either which way. But I think at a basic or a fundamental level, we are seeing at the moment trading ranges tighten, and we would expect to see, obviously, heightened levels of volatility and wider volumes and trading ranges as well, should it be a closely contested election journey. So I think, again, we're operating now in a highly volatile market. The Australian dollar, frankly, is at inflection point. It's got a fair bit of ground to make up to retrace steps up to 74 US cents But equally, we saw it last week down at a 10-week low, holding on to 70 US cents. So I think all things considered, I said, we are eyeing off some key risks on both sides of its current level. So I think, you know, we call the market today for what it is. And I think what it is today is, as I said, there are a fair degree of uncertainty as to whether it's going to push higher or in fact it could breach 70 on the downside. And I think that acts as a really good segue to speak around currency risk management. So I think firstly, as I mentioned earlier, one of the key roles OFX often plays with a lot of customers is one of our roles is around awareness. And it's also, I suppose, raising levels of consideration around how businesses can, in some circumstances, eliminate FX risk, or I suppose in an ideal sense, manage some of the FX risks some businesses may face. And too often what we do uncover when we're having these conversations with a lot of SMEs, and in some circumstances as well, a lot more complex and global operations, is that FX risk considerations are often secondary to those that businesses would typically consider. And again, our role in obviously helping businesses craft out, in some cases, a relatively basic currency plan. What it can actually serve for a lot of businesses is it does place, I suppose, a heightened level of accountability against the plan, as to saying being a little bit vulnerable to the spot markets of today. So again, some of those key considerations that will generally, I suppose, provide a little bit of a framework for organisations. The first consideration that we'll always talk about around a currency risk management or a currency plan, we'll talk about understanding, in a very elementary sense, what is your own understanding or what is your own risk profile. Now, this can obviously be applied in a personal sense or a business sense as well. So firstly, in terms of, you know, a risk profile, are you, by your own orientation, obviously a business which is highly risk adverse, I suppose, versus a business which is highly risk tolerant? There are all different ends of spectrums in terms of the types of risks you are willing to obviously adopt within your business model, but this should obviously serve as a very key starting point in determining what types of frameworks and how active, frankly, you want to be in mitigating risk in your business. Tied very closely to understanding your underlying risk profile, I suppose some of the big questions that are put down on this page can often help businesses understand whether they should be, you know, very risk tolerant versus have a built-in level of heightened appetite. And some of those really big questions often speak to, you know, frankly, are you a business that is operating in a hyper-competitive industry? Are you a business which is operating as well on some really tough operating margins? If you can answer both of those questions, it should often go a long way, frankly, to understanding how risk adverse or how risk lenient you should be. Again, if you are operating in an industry, there's only one or two competitors. If your net operating margins are circa 30 to 40%, if you do have a unique product or service which enjoys, I suppose, a general monopoly in terms of how you operate, again, all of these things do speak to a little bit more elasticity and often do speak to a heightened level of competitive strength. And as a result, again, you may well overlay that to say, hey, as a business, I can take a little bit more risk, and I can actually absorb a heightened level of FX risk in how you operate as well. But again, once you understand your level of tolerance, it does come back to a foundational need, frankly, to identify some objectives. You know, that is from a starting point, frankly, what are you looking to achieve? And again, too often we are finding, you know, a lot of organizations, generally, they will have a bias to being underhedged. Or frankly, a lot of businesses, you know, they will typically, suppose be defined by a degree of undermanagement in how they approach FX risk management. But really, as a business, look, what are you looking to achieve? And we will talk very briefly around some of the common objectives that are regularly used and are frankly well used across many of the organisations that we do assist. But again, some big questions. As I mentioned earlier, understand your operating environment, understand your competitors, understand how elastic you are in terms of how you can set prices. But I think most importantly, understand at a starting point, what are the consequences of your exposure? And frankly, what are the consequences of your inactivity? Often at a grand scale, I suppose, some really raw consequences of inactivity can speak to financial instability. If you are an importer, again, not being able to manage or control that exchange rate variable, it can lead to obviously a blowout in your cost base. If you are an exporter, again, you're looking more at a revenue or obviously the profit line within your P&L, and that can again be profoundly impacted by an exchange rate movement. So again, whether it's on the profit or in fact the cost side of your P&L, exchange rates do matter. And I suppose over the longer term, particularly over the course of 12 months, inadequate risk management proxies this year, frankly, could result in a 20 to 30% variance in your underlying P&L. I think finally, one, I suppose key consequence, which often isn't spoken about overly regularly, is the direct impact that your FX risk management measures can actually have in terms of your overall level of competitiveness. Now, again, I'll use the example of an importer. If you're an importer today, which has done a really great job of being very active in hedging your exposure, if you have been able to achieve exchange rates above 70 US cents throughout the course of this year, obviously you are at a distinct advantage versus a competitor who, say, hasn't achieved that type of exchange rate outcome. And if you were very active and you were forced into making exchange rate decisions when the Aussie US, of course, was down at 57 US cents, only back in March of April this year, straight away you've got a 30%, I suppose, pricing advantage versus that of your competitor. So understanding the dynamic in terms of how this places you versus people who are offering a similar sets of product and services can be a really key consideration, or in fact a big consequence of getting decisions around your currency choices wrong. So I think firstly, look, some common objectives, and again, these things they're rationally applied. I think they can really add some profound value to underlying businesses. The two objectives that we will talk about today as well, really keen to acknowledge that they can actually be synced and they can be used, in unison as well. So I think firstly, the first thing that we often talk about, and it's quite similar to an example that I've already offered up, is the use of a target rate, or in fact, a break-even rate in your business model. What businesses can do, and again, you can pair this to the optimal use of product. Businesses can go about setting or plugging in a target or budget rate within their business. And what that does allow is obviously provide certainty, again, from a cost or a profit perspective, does provide certainty over what exchange rates are embedded in your business model. It creates certainty in terms of how you can set prices. And again, it does eliminate a key risk in how you are operating. I might use the example today. If you are looking to navigate the FX market over the course of the next 12 months, you may well go setting a target rate, say an Aussie US exchange rate of 68 US cents. You can plug and play that exchange rate into your business model. By doing so, you will be able to secure, if you are an importer, an Australian dollar cost base against your known exposure in US dollars. If you were to say supplement that with a defined hedge ratio, we'll talk a little bit around hedge ratios. So essentially, if you are an importer, which at the beginning of the year makes an approximation over what their cost base is going to look like. Let's say you've got around 100,000 US dollars worth of US exposure that you need to navigate over the course of the 12 months. You may look to make a determination to hedge actively a set percentage of that $100,000 exposure. So again, by example, if it's a 60-40 hedge ratio, you might be very active and you might look to set a budget or target rate against $60,000 worth of that exposure. Now, what that does is it does place a floor and in fact a ceiling over 60% of your cost base. The benefit is you've got certainty over a small portion of your portfolio, whilst equally it does allow you to participate and absorb a little bit more risk for only 40% of that $100,000 parcel. So suppose in that example, you've got certainty on 60% and you've got the ability to participate. Should the market say push higher than 68 US cents, or should the market push higher than your targeted rate, you can capture those upside moves and participate in the markets of today. Now, in that example, again, we are, I suppose, combining a budgeted rate of 68 US cents, and we are combining a hedge ratio, which is to say you may well be able to get 68 US cents on 60 grand worth of parcel. And again, you've got participation to the top side. You can use either or, but again, it depends on what, firstly, your risk appetite does look like. And again, you do want to pair some of these approaches to your objectives. So again, typically a business which is highly risk intolerant, highly risk adverse, typically what you will see is hedge ratios pushing closer to 100%. If you are, I suppose, someone who, again, would prefer to fly a little bit closer to the wind, if you do enjoy the ability to operate with high levels of exposure, then again, you may well be choosing a hedge ratio, say 20% hedge versus 80% of participation. But again, you do want to align an objective to your underlying risk profile as well. I think, again, once you've understood your risk profile and you've set some objectives, typically it is really important to partner with somebody that can assist you with choosing the ideal, I suppose, mix of products to align to your objectives. We'll do a little bit of a deep dive shortly in terms of the types of products which are available. But again, in this day and age, it's really important to call out the availability of products. The level of awareness around products is only going one way, in that it is improving, and the access, both in terms of expertise in a personable sense. So again, you can contact people to talk you through your options. That is also paired quite nicely at the moment to online access as well. So a lot of these products can be transacted through your online portals at home. And we'll obviously give you a bit of a run through in terms of how the OFX platform does look and feel if you were to transact online as well. So I think finally, look, some basic tips before we jump into some products. Some basic tips in terms of businesses who are looking to build out, again, a little bit of a framework around currency risk management. I would say the first tip is set yourself up for success. And what I mean by that is make, where you can, obviously really rational, really well-informed, and really measured decisions around currency choices. Too often, currency choices are made both on emotion and equally they're made off the markets of today. So again, the markets of today can play a role, and they should play a role in how you go about making informed currency choices, but it shouldn't obviously be at the expense or in the absence of a well thought out plan. And again, today's market there's a lot of noise. Every single day there are economic announcements, and there are variables which are playing quite a big role in changing the value of exchange rates, frankly, on a daily basis. But if you are going to let the market play an active role in the currency choices you make, again, you do want to set yourself up to understand what's a foundational shift versus, frankly, something that can be ignored. Again, partnering with currency specialists, again, we can help you, and your partner can help you, I suppose, decipher between, frankly, the pieces which matter and those which are, I suppose, noise more on a daily basis. I think, the second tip, again, which I'm happy to share is, it's not too different, but again, be situationally aware. Don't overlook natural opportunities to eliminate FX risk. And frankly, don't overlook opportunities to offset some of that risk as well. A classic example of this is an importer which might have a US dollar cost base, and their cost base in the main will frankly, far outstretch any revenue streams they've got in US dollars. But if you are a business which have a small amount of US collections, again, you want to be isolating those US dollars to offset some of your cost base. And as a result, again, you're not offsetting the entire level of exposure, but you are reducing your level of exposure, frankly, by not having to take any risk at all. Point 3 is a really interesting one from my mind as well. And again, we see this too often in an importing example. Time is your friend, which is to say that if you get FX currency decisions wrong, it can actually heighten the level of risk that your businesses face instead of offsetting or reducing it. And again, the classic example is that an importer may well be facing a risk at a transactional level, which is to say you'll receive an invoice on day 1 and you're not committed to paying your suppliers until day 90. Now, in that example, too often we'll see an importer look to hedge or look to make a currency decision on day 1. But the reality is they are locking in their total level of exposure on what is happening on the market on day 1. But the reality is they've got the full benefit of operating and making currency decisions actively through a full 90-day cycle. And again, one of the advantages of doing that is you are going to, I suppose, reduce the risk of getting your choice wrong on any particular day. And equally, what you will likely see is a more satisfactory currency outcome over an extended period of time. And again, the main objective of currency risk management isn't around getting it right or wrong on one particular day. A satisfactory currency outcome can speak to, frankly, just, I suppose, avoiding some of the really nasty edges which can surface at any particular point in time. So again, if you've got an invoice which is due over 90 days, theoretically, let's assume the cost of that invoice is $100,000. A very active approach to managing risk at a transactional or an invoice level may well simply be to break that payment down into 3 or 4 different tranches over 4 or 5 different periods. Again, if you're executing on day 1, day 15, day 30, day 45, so on and so forth, you can imagine through adopting that type of technique, yes, you're a lot more active, but what you will see is a lot more averaging and a lot more smoothing in terms of the exchange rate outcomes that you are able to achieve. And again, the benefit of doing that is, again, you will likely, you will definitely obviously remove the risk of getting it wrong on day 1. And then equally, you will get a more satisfactory outcome over an extended period of time. So at a very basic invoice or transactional level, there's benefit to using time. And then obviously at a broader spectrum for businesses who are regularly exposed at the transactional level, you can use a whole heap of layering and smoothing techniques, which are very simple to, again, reduce a lot of the ugly edges, again, which can surface. Look, I think finally, there's probably 2 sides to this final tip, which is an acknowledgement that FX risk management, it's not a perfect science, which is to say that if you are new to FX risk management, there's a lot of advantages in starting quite conservatively. There are quite a few available products which can be, frankly, test and learn in terms of how effective they are and how right they are for your business. So again, we don't need to necessarily start an FX risk management program at a grand scale. You can obviously start very conservatively, and there are some products available to help almost at an introductory level as a starting juncture. I think the second part to this final tip is, again, a little bit of test and learn. And I suppose a really important acknowledgement that there is a constant review cycle that often happens in currency planning, currency provisioning. Again, if you're sitting down at the end of each month or the end of each quarter, and again, you are looking back and you're baselining how effective your decisions have been or how accountable you've been against your currency plan, you want to look at those regular review cycles to learn and to assess, I suppose, not only how accountable you've been against your plan, but how effective it has been, and frankly, whether it is still, fit for purpose in any particular environment. Okay, so I suppose that's a basic overview. I think if I was to enter today's webinar, with one or two key objectives, I think it would be fantastic if everyone could walk away with, 2 or 3 really key tips in terms of things they should start to think about if you're not already thinking about these types of things. Again, a currency plans, it's around risk profiling, it's around setting some objectives. And again, finally, we'll talk about it now, but it is about pairing those objectives in your profile to some different products. Again, the more that you invest and the more active that you are around FX risk management, again, it's obviously going to accelerate the maximum benefit that you can unlock. So look, in terms of products, again, I think it's really important, an active role we play is just to break down some of the stigma, which is often associated with hedging products. And again, that hedging products can be very basic and they can be highly accessible, both over the phone and online as well. So what I'll do from a starting juncture, we'll talk around some, again, some basic money transfer options. So again, these are things like a spot exchange rate. Again, and everybody will often have a need simply to buy a set amount of currency at a set exchange rate at the underlying rates of today. And again, customers of OFX can do that in a live environment 24/7 through our platform. A lot of customers can also utilize what we would define as a limit order. So again, a limit order does allow a business, or in fact even a consumer, to set the exchange rate that suits them. It is a target rate, and you may well nominate a target rate for a set amount of currency. And in that example, OFX will do the watching for you. And if and when that exchange rate is achieved, we will purchase that amount of currency at that exchange rate on the spot for you. So again, 2 of the biggest benefits of limit orders is it can, I suppose, provide the opportunity for businesses to capitalize on overnight markets. So again, we know Europe and the US, again, there's typically a lot of movement, frankly, when Asian and Australian markets are asleep. And again, we will watch the market, we'll execute in an automated sense on your behalf. I think secondly as well, there may well be an ideal rate that a lot of businesses or consumers are looking for. And again, to save customers having to constantly quote and re-quote and to jump online, obviously we'll do the monitoring for you. Again, as an automation or a trigger, and we'll inform you if and when those rates are achieved. I think finally, what we'll talk a little bit about, frankly, is forward exchange contracts. Now, again, forward exchange contracts are a fantastic product and a very useful product, particularly when referenced against those 2 hedging objectives I spoke about briefly. If you are looking to set an exchange rate or protect against a target rate, forward exchange contracts can be used, very well. And as equally as well, if you are looking to define a hedge ratio in your business, you may well be looking to obviously hedge, as I said, a 60-40 model. You may well be looking to use forward contracts 60% of the time to achieve a 60% hedge against your total exposure level. But I think at a basic level, again, forward exchange contracts, they do allow businesses and they do allow consumers, the ability to secure an exchange rate on day one for a set amount of currency for a defined future date. So again, I'll give final example on forward exchange contracts. If you are an importer and you do want to, I suppose, protect on day one for the full period of a 90-day invoice, you may well look to secure a forward exchange contract on day one. That'll lock in an exchange rate. It will provide absolute certainty on day one for the full term of that invoice. The key benefit of obviously, forward exchange contract usage is that it does provide 100% protection. So again, in volatile markets, if there is a little bit of a downward risk or a bias, I suppose that the AUD might be not just temperamental, but potentially heading north again, they will provide an exchange rate floor. And I think beneficially as well for a lot of businesses who are looking to hedge across multiple invoices for extended periods. Forward contracts can be used up until 12 months, which means the business could not only draw down on the value of a set contract, you can actually extend your contracts out up and as well. So there's a whole heap of flexibility built into the settlement dates and frankly when they are used. So what I'll do briefly, before we jump into a little bit of a demonstration in terms of the OFX transfer, process, we've provided, a couple of examples in terms of how two particular businesses are utilising the services of OFX today. Now, the first example and the first spotlight that we kind of wanted to illustrate today is a customer, that's been with OFX for quite a period. Shine-On, frankly, is the name of the business. Shine-On have been importing commercial energy efficiency products, including solar panels and LED lights, from China since 2009. So again, it's a business which has had exposure for 10 or 11 years now, and it has come, I suppose, well versed in the risks, particularly around that Aussie-China corridor and the Aussie-US corridor as well. The predominant need for OFX in this customer's circumstance as a starting point was cost-led. And again, that he was using his existing bank and he was comparing regularly across different FX providers. But again, the key result and the key reason he's mindfully benefited from the likes of OFX speaks actually directly to some of the cost benefits in doing so. And there has been some real value and some cost savings from an exchange rate and a fee perspective. The other customer example is actually Ninchibo. Now, Ninchibo is New Zealand's largest leading car exporter of used vehicles. It does sell to dealership groups worldwide and has again been using OFX for a period of 8 years. Ninchibo has been enduring problems with FX for many businesses with global operations. So again, exchange rates do have a really big impact in terms of the costs built into their business. That volatility can obviously trigger a whole heap of disarray internally. And again, it can create a whole heap of uncertainty around margin security for them in particular. So they obviously went for a search 8 years ago in terms of a better solution. Again, existing bank customer, and they did turn to OFX, I suppose more from a perspective of expertise, in that they really did value access to a dedicated dealer. They did really value that domain knowledge that a personalised account manager can provide. Again, they weren't necessarily getting that level of specialism and that level of deep domain knowledge versus their incompetent. So again, the result, look, Ninchibo have been using OFX now for 8 years. We have, I suppose, formed a fantastic relationship with Ninchibo now to the point where, again, they are really benefiting from some added certainty around how they can eliminate and manage FX risk in their business. So often would love to welcome some questions from today's audience. Before I do, what I will do, I'm just going to press play on a little bit of a video just in terms of for existing customers or for anybody who is interested in obviously trying out the OFX platform. This video is a little bit of a mouse flow in terms of how our platform does look and feel. So this will only run for a short minute. Fantastic. So that final video is just a bit of a detail in terms of how the platform does look in a live sense. So that example was just a basic spot payment. So a customer looking to purchase US dollars, and in doing so, nominating a recipient and a reason for payment. Look, a very big thank you to today's audience. As I said, did want to provide a little bit of orientation in terms of today's market, but more importantly, hopefully everybody is able to walk away from today's discussion with 1 or 2 basic tips and 1 or 2 basic considerations around how you can obviously look to mitigate some FX risk versus how you're currently operating. If there are any questions, as I said, would welcome them now. Otherwise, we do, of course, welcome any inquiries or any questions after this forum. So if you did want to visit us, we can be found at ofx.com. Equally, we can be contacted at corporate@ofx.com. But if there are any questions, would welcome them now.
Thank you, Michael, for this insightful presentation. There doesn't appear to be any questions. However, as Michael just mentioned, if you would like to get in contact with him, you can do that through corporate@ofx.com. Over the coming days, you will receive a follow-up email with a link to view today's recording along with some supporting documents. I will also include the email address as part of this email. On behalf of Michael, Judge and APA, thank you for participants in joining us today, and I hope you all have a great afternoon. And thank you very much, Michael, once again.
Thank you. Pleasure.